2, 1.
A very good morning. Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney. We're counting down to Asia's major market opens. Good evening from Bloomberg's world headquarters in New York. I'm Shery Ahn. The top stories this hour. A big tech rally fuels a rebound in U.S. stocks with the Nasdaq 100 closing at a record high and TSMC's positive outlook lifting chip makers. Oil rising alongside equities as tensions shimmer in the Middle East and American stockpiles fall to the lowest since October. Geopolitics also high on the agenda at Davos, where we'll hear from the RBI governor and the CEOs of Bank of America and Trip.com. This was a close on Wall Street. U.S. stocks gaining for the first time in 3 sessions. We had mega caps leading those gains. Apple getting an analyst upgrade as well. We're watching the Philadelphia Semiconductor Index seeing its best day in more than a month. And this, of course, coming after we saw that positive outlook from TSMC, spurring hopes for a global tech recovery. Treasuries ended the session a little bit mixed. The 2-year yield was down. The 10-year yield was slightly up. It was really a reaction to resilient data, jobless claims dropping to the lowest level since September 2022 last week. The dollar was mixed versus peers. Of course, we did have the Bloomberg dollar index topping its 200-day moving average. Oil rising alongside equities with the widening conflict in the Middle East, adding to those gains. And we also had U.S. crude stockpiles dropping to the lowest level since October. But Heidi, of course, it is all about the Fed trajectory and what kind of clues we can get from Fed officials. And today we heard from the Atlanta Fed president, who wanted to see more evidence that inflation was going to stick around that 2% inflation target. And he really didn't want to go what he called back and forth on those rate cuts, that would be the biggest fear, that if they had to cut and then raise them again later, if inflation moves higher, that would really not be good for the U.S. economy. We also heard from the Philadelphia Fed President Patrick Harker also saying that he expects inflation will continue to move toward the 2% target.
It really is continuing to be about communication and signaling from these Fed speakers, right, as we get into this year, which potentially markets have priced in 5, maybe 6 rate cuts. The sort of expectations are really running perhaps ahead of the commentary that we're actually hearing from policymakers. But at the same time, we've got to go back to the data, right? We know that this is what Chair Powell and his colleagues will be looking at very, very closely in the coming months. And at least when it comes to the jobs market, we're continuing to get, Shery, more and more signs that the U.S. labour market is just showing signs of resilience. The latest numbers, jobless claims plunging to 187,000. This is the lowest since September 2022. New York posting the biggest decline, followed by the numbers for Michigan. So these continuing claims falling for a 3rd week as well to the lowest since October. So really kind of underscoring the robustness of the labour market at the start of this year. We've also, of course, been hearing a lot of these conversations taking place at the World Economic Forum in Davos. Take a listen to what some of our guests and the industry leaders, policymakers and business heads that we've been speaking to have to say about their outlook for rates.
It's going to be a bumpy year.
The market might be a little bit ahead of itself in terms of rate cuts this year. I have no doubt that we'll get to rate cuts at some point.
They're going to have to start cutting because they have the space to cut and the economy can keep growing.
The markets have now priced in what I think is probably excessive interest rate cuts in the U.S.
We still see rate cuts, and we are actually predicting that they start sooner rather than later.
Our core team has 4 cuts and 4 cuts, 24 and 25.
The 6 rate cuts, that's a pipe dream if we have a soft landing. That's not happening.
I think markets are being a little exuberant, expecting as many rate cuts as they've put in.
The market is now calling for a 175 basis point cut by the Fed. Really? How about this? No way. No way at all.
They're going to be prudent. They're going to be thoughtful.
Let's bring in Matt Lloyd, who's a chief investment strategist at Advisors Asset Management. Matt, great to have you with us. So, what's your positioning in terms of how you feel about market expectations versus how you think the Fed will actually proceed this year?
Yeah, that touches on probably the primary question, and maybe it's 2, it's when and why. If you look at what the Fed is doing, what the numbers are saying, and really the salient figures out there and metrics, you look at what you mentioned before, the job market is pretty robust and strong. You now see some shipping issues. There's still some inflationary concerns out there. And I think when you look at the when, it's really the when is now trumped the what and why of what people should do invest. Now it's when. When is it going to happen? And then the reason on the rate cuts is, you look at the difference between the futures and you look at expectations and you look at what the Fed is trying to transform into the dot plot. Maybe it's the not plot anymore. But 3 cuts versus 6 to 7 cuts, which are kind of in the market, maybe the shadow expectations, you start to see that the win has actually become more problematic on this in that situation. And then it's going to have to recalibrate all the assumptions that are priced into the market because of that, whether that's equities or the debt market.
I love, Matt, you talking about the markets trying to work through the 5 stages of grief since 2022. What stage are we at the moment? And, what is that a precursor to, I guess, for the rest of this year?
I think we go through all 5 stages at every point of the day. It just depends on what you look at, the cacophony of information that's out there. I think, when you look at it, the acceptance to a degree is more that the soft landing is going to occur. So that's where everything is. So as an investor, and always have to watch the blind spots and look at the asymmetrical risk and reward scenarios of it, you have to start thinking of what's not priced in, whether that's the no landing or whether it's the hard landing. We're seeing a little bit of a definition shift in the soft landing, which most people would say soft landing is still growing, but they can cut rates and so forth. Now we're seeing people kind of recalibrate the soft landing to a shallow recession. We're in the shallow recession aspect to it. And that's not necessarily something that should make everyone run for the doors. What it should say is just be a little bit more pragmatic about it. Look at those things that have value. I think one thing that's probably underestimated and is shown is that value outperforms growth in presidential election years pretty much by a wide margin. And so we think that that's a good place to be, a little bit more overweighted in value and quality in that side. And then just measure risk. International has some very good risk reward scenarios. Unfortunately, their economic numbers are a little bit more anemic, a little more troubling. So there may be some more volatility in that aspect. But I would love to say acceptance, but I think that changes by the hour.
Does international include emerging markets? Because we have seen the big losses this year already. EM stocks losing more than 6% year to date, and we're just in the middle of January. So could we see some more upside if what you like is value at this point?
Yeah, really, international investing really is always geared more towards value in general. I think, though, when you look at emerging markets, you really want to follow what the dollar does. And the dollar is going to be in a trading range. And there's a couple reasons for it. If you look at the dollar, if there's a little bit more of an upbound move in interest rates, then you'll see the dollar kind of rally a little bit around it. If there is a recession or there's economic troubles, there'll be a flight to safety that could stabilize and increase the dollar. However, longer term, you're going to see the budget deficit issues, the refinancing of debt at higher rates, the debt to GDP ratios, which is going to ultimately keep the long-term trend of the dollar down. That's long-term bullish for emerging markets. So you're going to see some volatility this year in emerging markets, but the amount of dollars invested in emerging markets relative to, the U.S. assets is as low as we've seen, and the value based on the price multiples and so forth, and even the growth going forward doesn't translate to earnings, but we would be a long-term believer in emerging markets. China's really kind of dragging it down, and China, for the contrarian and value-based investors, the cannons are going off in China, and that's usually as value investors where you want to look at it. It's just hard to do that with the negative feedback loop we have. So we like emerging markets. We'd probably be systematic and methodical about it throughout the year. And look at the dollar. If the dollar rallies, that would probably be a good entry point because they'll be a little bit depressed. But we like emerging markets, especially over the long term.
We continued to talk in 2023 about how emerging markets seem to be really getting detached from where China goes from here, because Chinese stocks really underperform, but emerging markets ex-China actually did not that bad. Same thing for when it comes to EM currencies. Could we see that trend continue in 2024 and therefore see more upside for EMs even if China doesn't recover?
Yeah, I think you're hitting on a really key tactical point in what's going on. And this has to do with globalization, the just-in-time manufacturing, and you start to see the cost of labor in China. You look at the fertility rate and demographic situation. So it's naturally going to increase wages. We've seen that dramatically over other various emerging markets. So that trend is going to benefit that. So you're going to be kind of diversifying your manufacturing base. You're going to see a lot more storage here in the United States for those that are utilizing it for domestic. I do think that there is going to be a delineating case for that, because some of those challenges, and they'll still have a massive impact, China will definitely, but I do think that the other kind of satellite emerging markets, and it's hard to say like India is a satellite, but you look at India, you look at Taiwan, and I know there's challenges there, Vietnam, those are all places that actually we would be a little bit more bullish on. And even in South America, if you look at like Brazil, I still like Brazil in the sense with some of their agricultural aspects and where they're becoming a bigger player in the emerging markets. But I do think your point is well said. It is going to see a little bit more of a break, and it's going to be maybe a little bit more individualized is what you want to be versus maybe doing a broad-based.
Matt, how much are you watching geopolitics for this year? I mean, it seems in a lot of ways extraordinary how investors have been pretty sanguine, given that there are two, active conflicts that are still playing out. Even across oil prices, perhaps we're starting to see a little bit more of a bigger move across the futures curve. How big a risk is that, do you think?
Yeah, it's a big risk, and it's always a prominent risk out there, and it flares up, and election years kind of usually exacerbated. This is not being exacerbated. This is actually realized. And this is what's causing maybe what we're talking about with the dollar rally, kind of a risk off flight to safety, if you will. Now remember, flight to safety is typically they have to land, refuel, and then they take off again. So the dollar rally will probably be just a little bit premature. But it absolutely is something that's prominent. And this is where really measuring the risk reward, high quality in the sense of what you're looking at. It is contagion. There's contagion inside this, all the different areas. You see the news now with what's going on with Pakistan and Iran. This is a hotbed. This is something that's not going to be able to be isolated. I think that that's going to create a little bit more angst in the markets, which with money market rates as high as they are, high yields on sovereign debt as far as the U.S. Treasuries, you're going to still continue to see a flood there, which we've already seen. You're seeing households own $2.3 trillion of Treasuries, never seen before, because of that nervousness, and it's a cash proxy, if you will, for it. So you're already seeing it a bit with the high levels of cash and high levels of high-grade debt. But I think that that could be the capitulating moment in the markets where there's a risk to saying, all right, we're just going to pause on risk for the short term. And so I do think it's already played out. There's probably a capitulating moment in that from those geopolitical risks for sure.
Does the outcome, whatever it is, of the U.S. election, tactically change anything for you?
Yeah, I think that because it's so played out, and it is very polarized. We become more tribal because ideologically speaking and so forth. I do think that somewhat is as priced in, and we always are kind of over amplifying the risk of uncertainty moving forward. The way we see Congress being really kind of middle of the road, both parties kind of having 50-50, very low margins. It's almost going to be more of anemic lame duck sessions, which isn't necessarily good. In the times when things are going great, that's actually not a bad thing. When you have these consternations and you need things to kind of get done, that legislative constipation, so to speak, does not help out. So I think that that's what the markets are somewhat priced in for already. I don't think there's going to be a big culture shock whoever wins on this, because we've already seen this ideologically shift over the last 8 years. So some of it's not going to be priced in, but I don't think it's as visceral as the geopolitical risk out there.
Matt, great to chat with you as always. Matt Lloyd, Chief Investment Strategist at Advisors Asset Management. Well, coming up, Israel vowing to control security in the Gaza Strip after the war, despite calls by the US. An update next on the crisis playing out in the Middle East. This is Bloomberg. Well, Ukraine is aiming to organise a call with Chinese President Xi Jinping to push forward its blueprint for peace. The Ukraine-Russia war is among the top geopolitical issues being discussed at this year's World Economic Forum taking place in Davos. Bloomberg's Anne-Marie Hordern has more.
When will central banks start cutting rates? How geopolitics is impacting the global economy? And of course, what to make of the consequential U.S. election coming up in November. These were the top themes at this year's World Economic Forum in Davos, Switzerland. And more than just a business meeting. This was really a conference as well for top foreign policy minds. We had Secretary of State Antony Blinken at the same conference of Iran's foreign minister, even as we see at this moment hostilities continuing in the Red Sea. But one geopolitical risk that really overshadowed the event was Ukraine. That's because President Zelensky was here making his pitch for the aid to continue, and not just from Washington and Brussels, but also from the private sector. We spoke to Dmytro Kuleba, Ukraine's foreign minister, who said he was reassured that that aid is on the way.
Well, we received reassurances that the aid is on its way. The good news is that we see that the Congress is not debating the aid to Ukraine per se. The discussion is on the border issue, and there are no disagreements on whether and to what extent Ukraine should be helped.
And when it comes to the elephant in the room, former President Donald Trump, Kuleba says that Ukraine is ready for whoever Americans elect. Anne-Marie Hordern, Bloomberg News, Davos.
Israeli Prime Minister Benjamin Netanyahu says his nation will insist on security control over the West Bank and Gaza Strip after its war with Hamas is over. Let's get more from Nick Wadhams in Washington, who leads Bloomberg's U.S. national security team. And Nick, this is not making Washington too happy.
No, I mean, the Biden administration has said very clearly that they believe the only real future for the Gaza Strip is a Gaza Strip that is run by Palestinian authorities. So you have this tension point here between what Netanyahu is saying and what the Biden administration has advocated for repeatedly. So big question of how this is going to play out going ahead in the next few months. But today already the State Department essentially rejected Prime Minister Netanyahu's claims with a spokesman, Matthew Miller, saying, listen, there's a real opportunity here for Israel, and there's essentially no path forward but one where the Gaza Strip and the West Bank are run by the Palestinian authorities. So this is a crisis that we're just going to have to see how it shakes out, whether they can move Prime Minister Netanyahu off of that insistence he's maintaining.
President Biden says the Houthi strikes haven't deterred the group. So what options remain now?
Well, it's a great question. I mean, so we have what's happening between Israel and Gaza, and then the sort of proximate issue, which is the Houthi attacks on commercial shipping in the Red Sea. The Biden administration has now launched a series of attacks designed to degrade the Houthis' capabilities, but they essentially recognize, listen, this is not going to deter the Houthis. The group has said as much. So I think what you're going to see now is a bid where they're going to essentially keep up these strikes, but also look to sort of, on the back end, pressure Iran to exert some influence over the Houthis to get them to stop. The question is, how do you do that? How do you press Iran without getting into a direct conflict with them and keep this war, the violence in the region, from spreading even further? So far, that is a question the Biden administration does not have an answer to.
Bloomberg's national security editor Nick Wadhams there. And not surprising, oil remains volatile as the conflict in the Middle East continues. Plus, U.S. crude supplies fell sharply last week, not to mention that freezing temperatures have also curbed some refining operations. So we're seeing oil futures moving higher in New York and London trading. Bloomberg's Sue Keenan joins us now with the latest. Sue, let's start with the shipping chaos in the Red Sea.
Yeah, there's a general view that the situation has now gone from bad to worse, and that the general result of the U.S. and U.K. strikes on the Yemen bases of the Houthis has been to result in sharp declines in whatever shipments had been going through the Red Sea. And that's an area that handles about 12% of the global trade. The result of these attacks has seen the flows of oil, gas, grain meaningfully decline and be diverted through other routes. Additionally, as just mentioned, we had bullish inventory data here in the U.S., a decline in oil stockpiles that took us to the lowest level we've seen since October. So analysts and traders are saying we're really searching for direction as we enter 2024, with volatile days where we've seen swings of oil between $2 or more in one direction or the other. Layer on the fact that one of the big themes for 2024 for oil has been the oversupply of oil. Again, you're looking at green on the screen in this latest session, but bigger picture, you can see where oil, which had been heading higher, has really moved sharply in both directions lately. The IEA is saying that oil markets look reasonably well supplied for the year. Supplies outside OPEC Plus, which include the U.S., are a main reason that we're seeing supplies grow faster than global demand. And that big picture is a bearish effect on oil.
Severe winter weather, of course, we've seen all the crazy videos and pictures across social media. Has this had impact when it comes to Gulf Coast refining capacity?
Yeah, short term, it's really crippled Gulf Coast refining capacity, and that was just one of the extra bullish factors. If you live here in the U.S. on the East Coast like New York, we're all feeling the frigid temperatures and light dusting of snow in New York, but in the Northwest, Dakota, severe dumps of snow. What's unusual is that this cold weather snap extending even to the southern part of the country, such as Texas and the Gulf Coast, where you have the major bulk of the refining industry. Temperatures in Texas have fallen well below freezing in the past week. That has shut about 15% of the U.S. Gulf Coast refining capacity. And these disruptions come at a time when ample supply of fuel on hand has been limiting the impact of the price. That said, with a lot of the trading here in New York where you can feel the cold weather, a key gauge called time spreads has been surging on this combination of factors.
Well, we're so keen on here with the latest on oil prices. And of course, we're following the latest when it comes to a temporary spending bill here in the U.S. The U.S. House of Representatives is set to pass the temporary bill to avert a partial U.S. government shutdown this weekend. It's already cleared the Senate and will head next to President Biden's desk. We're just seeing the latest line drop on the terminal from the White House saying that President Biden will in fact sign the stopgap funding bill. The interim measure will fund some U.S. agencies that are set to run out of money through March 1st and others through March 8th. We have more to come on Daybreak Australia. This is Bloomberg. Take a look at how we're setting up for the Asia trading session. We're seeing Kiwi stocks rebounding 0.25% after losses in the previous session. The Kiwi dollar also holding pretty steady. And we might see some upside given that, of course, Wall Street had gained ground for the first time in 3 sessions or so. And the ASX 200 has already been down for 5 consecutive sessions. And you're seeing right there, the futures are pointing higher. Also, when you're looking at Nikkei futures, we could see some upside. We're seeing futures up 1.6% after 3 sessions of losses already. The Japanese yen, very little change after falling to the weakest level since November. Of course, today, the big data point in Japan, its CPI report, which will likely back the Bank of Japan's assessment that upward pressure that we saw in input costs earlier last week is starting to weaken. We have plenty more to come on Daybreak Australia. This is Bloomberg. Welcome back. JP Morgan raised CEO Jamie Dimon's pay to $36 million for 2023 as the bank notched the highest profit in the history of American banking. That's an increase of 4.3% from 2022. Bloomberg finance reporter Catherine Doherty joins me here in the New York studio. So given how JP Morgan outperformed, how widely expected was this?
I think it was very expected across the street. Not the same for the other banks that are going to report in future weeks. But for JP Morgan, it's all about Dimon and what he's done for the bank in the last year, especially. Remember, March, we had a very tumultuous time in the banking industry. JP Morgan, and with Dimon's help, stepped forward, had bought First Republic, and that has helped them really grow into this new historical moment for the bank. And I think that you're seeing Dimon being rewarded for that, for all of the effort that he's put in, not just for First Republic, but for keeping the bank together and really focusing on growing profits moving forward.
What can we expect for this year, whether it's JP Morgan's performance or Jamie Dimon's performance?
I think we'll expect to see a little more of the same. You're hearing that from him as we're going into 2024. he is expecting, he's cautious, I would say, or at least more cautious than what you hear from other executives that seem very, very positive about the path ahead. He is pointing out some uncertainties that are still needing to be sorted out, with the Fed cutting interest rates. That not necessarily a guarantee, and in terms of the timing of that, that's also something that is hard to price in at this time. But with more certainty, I think that will help with any Wall Street business, and JP Morgan is saying that they don't need to rely on one source such as investment banking, that they're trying to invest in across the entire business line.
Morgan story, or do we expect increases, bigger paydays for other Wall Street CEOs?
I think it's really going to depend. You might not see the same increase as Diamond, perhaps flat, if not down for some of the other banks, especially for a bank like Citi that's thinking about reining in expenses. They might not give their CEO, Jane Fraser, the same bump that Diamond has got this year. But it remains to be seen. I would say that we look not just at the bank's profitability, but how their shares are performing. That is reflective of how investors are essentially expressing how they view the business and how each business is progressing. So you might be able to get a little hint on how each CEO will see their pay based on where their stock has performed over 2023. Remember, this is pay that is for 2023, which could be also reflective of how they view the move going ahead, but they're rewarding each CEO for the work that they've done in the past year, not necessarily a reflection of how they see the year ahead.
It's a long-running joke, right, that he says that he'll stay for 5 more years regardless of when he's been asked that question. We know that 2026 is, when he's committed to stay. How much longer do you see him leading JPM? Do you see beyond that date?
I do see beyond. At least that's what he has said himself. 2026 is not a hard stop for him. He's talked about his enthusiasm that he has for running this bank, and he has said that as long as that enthusiasm remains, he doesn't see any reason why he wouldn't be leading the business. And you might, as long as you also see this signal today from the board giving him this pay bump, I think they're on the same page. As long as the momentum continues, as long as he has the desire to stay, that's another question. If things change and maybe there's another potential role in government or across, it would be hard to see another role that he would see as appealing as the one that he has today on Wall Street, but you never know. Things could change, but at the moment, I don't expect, or I don't think anyone that I've spoken to expects Diamond to step into a new role at any time soon.
Yep, and keeping him happy with that $36 million paycheck for 2023. Our finance reporter, Catherine Doherty, there in New York. Well, when it comes to Bank of America's CEO, they see 4 interest rate cuts by the Fed in 2024 and 2025. He told us that the US central bank now has space to cut as the economy continues to grow.
Our core team has 4 cuts and 4 cuts, 24 and 25. And so if you sort of sort that through, people wouldn't interpret that, but that is actually higher for longer because you came off of 25 basis points, and if you end up at 3.5 next year, 8 quarters away from now. So I think the team, Mike and the team, they're saying they're going to have to start cutting because they have the space to cut and the economy can keep growing. And the last thing you want to do is tip this thing over. And so the consumer spending in good shape, their credit's in pretty good shape, the credit statistics, everybody's it's normalizing. It's normalizing at 19 and 18. Those are like 50-year good records in our company. It's not normalizing to stress. It's normalizing the base case. So if you think about that, they've got access to credit. Inflation hurts, especially median income. That's tough on people. That's what you read about. But in the end of the day, they've got it set up so they have to start cutting lest the drag gets too strong. And the housing market's got to get a little more oomph to it. You've got to get car purchases up. You got to get these things that kind of keep the economy rolling on.
Just on that housing point, how much do rates have to drop before you really see the mortgage market come back?
Well, I think there'll be 2 parts to that equation. If you got all the people in the consumer say, if you get a 6 handle consistently, or even high 5s, low 6s, then people sort of forget. You just need time too. And so when I got my first mortgage at 8.5, I thought I had a deal. I first went into business and the prime rate was 23. And so, but everybody's used to that. People aren't used to this. So it's going to just take time for them to think about it differently and get used to the pricing's got to flatten out and adjust. Their wages have to come up. But the good news is, most Americans have a fixed rate mortgage, which in an inverse sort of is an asset right now to have against the market. And so it's going to be slow in the first part of next year. It should start picking up as people get more and more used to this. And frankly, there's just a turnover in housing because people get divorced, get sick, you die, move to a bigger house. Those are very pleasant things.
Exactly.
But the reality is that's what happens.
That's what we need to unlock the housing market.
So there's always an activity. It's just that the refinance activity is mortgage driven, but that's done for a while. But the purchase activity will pick up because people have kids and want houses and things like that.
I'm curious, in your earnings call, you expressed some cautiousness around your outlook.
Yeah.
Other CEOs of certain financial firms have been less so, particularly at this Davos meeting. Talk about hiring, talking about the incredible boom in M&A, IPOs, everything coming back. How do you explain the difference?
Well, we're cautious because the economy is slowing down, and that's just how you have to manage expenses. We have a big enterprise. We, over the course of last year, probably went down 4,000 or 5,000 headcount. We still hired 15,000 people last year.
Bank of America CEO Brian Moynihan speaking with Bloomberg at Davos. And staying on banks as we look ahead at morning calls, given, of course, that we're headed towards the Asia trading day, Morgan Stanley CEO also spoke to us, Ted Pick, saying that the drought in mergers and acquisitions should ease once the Fed begins to lower borrowing costs with some level of predictability. Speaking with Bloomberg, Pick says predictability will be good for its core investment banking business. He also spoke about the opportunities he's seeing in Asia as the bank expects its wealth business to drive growth.
When you talk about 5 or 10 years and you think about the amount of aggregation and transparency of wealth outside the U.S., particularly in Asia, I've been going a lot to Japan. I go every quarter. We've doubled down on Japan. It's one example of the kind of place where we could do extraordinary business.
Well, on Japan, some market watchers say Japanese stocks risk becoming a crowded trade. Investor enthusiasm for Japanese equities dominating the region, with 59% of Asia's fund managers overweight on the country, according to a Bank of America survey this month. And that popularity has convinced strategists at HSBC and SocGen that the market has risen too far and investors should start taking profits. The top picks showing signs of overheating. Its relative strength index recently reaching the highest since May, the last time it breached the overbought threshold in September. That market share fell around 9%, but it has just been an astonishingly strong run out of the gates for Japan so far this year.
And Heidi, of course, we continue to hear very strong voices coming out of Davos. This time, the governor of India's central bank saying that rate cuts are not yet on the horizon, with no firm evidence that inflation has settled. Shaktikanta Das added to the chorus of policymakers warning that investors are getting ahead of themselves with bets on monetary easing.
Financial markets all over the world have started talking about rate cuts, whereas the central banks are nowhere near it, as per their stated, as per the statements which are coming out from various central banks. So far as India is concerned, inflation has moderated from the peak of 7.8%, which we saw immediately after the onset of the Ukraine war. Inflation has steadily moderated. It has come within our target range of 2 to 6%, but our target being 4%, we are still, moving towards 4%. So we have to reach 4%. Till we reach 4% on a kind of a sustainable or a durable basis, I think it will be too premature to talk about rate cuts.
But expectations are that you'll get to 4% before 2025, which means you'll get there this year. Could we see possibly rate cuts in the second half?
You see, I have said yesterday in another forum that next year our expectation of average inflation, for the whole year, starting 1st April 24-25, the average headline inflation is likely to be 4.5%, with several ups and downs. And unless we see a clear evidence of, or a clear unless we reach 4% and unless we see clear evidence that it is going to sustain at that level, it will be really premature to talk about rate cuts. And at the moment, as I speak to you, the topic of rate cuts, that aspect is not on our table. It's not even under discussion. Our focus is now to remain actively disinflationary, to bring the inflation to 4%.
And that was the RBI Governor Shaktikanta Datta speaking with Haslinda Amin in Davos. And you can catch up on all of those conversations. Watch us live on our interactive TV function. That's at TV Go. You can also dive into any of the securities or the Bloomberg functions we talk about, plus become part of that conversation. You can send us instant messages during our shows. This is for terminal subscribers only. Do check it out. It's at TV Go. This is Bloomberg. You're watching Daybreak Australia. Some of the corporate stories that we're tracking. Spirit Airlines says it is not pursuing a restructuring plan following the failed takeover by JetBlue Airways. Shares of the discount carrier fell again despite promises to strengthen its balance sheet. The stock has wiped out more than half of its value since Tuesday's court ruling, blocking JetBlue's $3.8 billion bid. Daiwa Securities says it's ramping up capabilities in Japanese fixed income as it gets ready for a long-awaited shift in monetary policy. The brokerage's deputy president, Keiko Toshiro, told us investors in Japan and overseas are paying more attention to rates as the BOJ gets closer to tightening policy.
We've been preparing for a while, not just ourselves, because of higher interest rates. And BOJ has changed the policy on yield curves. So we've been preparing. We're seeing people more interested with interest rates. So we will be allocating resources when we see it's correct.
Bloomberg has learned that Bobby Jane's company is no longer on track to have the largest ever hedge fund debut. Sources say he's told investors that Jane Capital now plans to launch with $5 to $6 billion for below its earlier ambitions for as much as $10 billion. The lowered expectations underscore a challenging environment for fundraising across the industry.
Haidi, the World Bank says developing economies will face a demographic liability unless they can triple the number of jobs being created for young people over the next 10 years. World Bank President Ajay Banga spoke to us at Bloomberg House in Davos.
If you look at jobs in the global south, this bubble of young people coming through the pipe requires 1.1 billion jobs to be generated in the global south over the coming decade. We are currently on a pathway to generate 325 million.
A quarter.
There's a small gap there. We need to worry about that gap. And I think that getting the right attention on jobs and women and young people is kind of important. The second thing that's really important externally is in Africa, where I think the future of many parts of our opportunity for growth and world productivity and safety will come from over the coming 20 years. Africa, 600 million people are not connected to power. I think electricity is a human right. You don't have electricity, you got nothing. Nothing. And so we're dedicated to changing that as well. So externally, there's a whole series of things, and we can talk about what we're doing on each of those if we get a chance. But internally, I've said that the 19 months that it took from starting the project to getting approval at the board, I'm going to bring it down to 12 months over the coming year. If I can do that, I mean, look, even if I get to 14, I'll declare victory, because 14 is better than 19. But you've got to set a plan. And I have an old colleague here from MasterCard in the audience. He will tell you, I tend to choose ambitious targets, and I'll declare victory if I do 90%, because 90 is better than where I was. There he goes. Yeah, there he goes. So I'm going to do the same thing here and aim for that. And then there's a series of other things being done inside. From career development planning. Right now, a lot of the career in the World Bank depends on who you know and when you work with them. I want to change that to what you do and how you do it, which requires really transparent career planning. There's a lot of things to be done to help make people in the bank feel that this is the best place for them to be.
World Bank President Ajay Banga there at Bloomberg House in Davos. We'll have a lot more from the World Economic Forum. Bloomberg's Francine Lacqua hosting the panel when it comes to the global economic outlook. We'll be hearing from the ECB as well as the German Finance Minister Christian Lindner, Carlyle founder David Rubenstein and Saudi Finance Minister Mohammed Al-Jadaan.
Welcome back. One of China's biggest names in tourism says the sluggish economy and slumping markets are not deterring consumers from getting back to travel. We spoke at Davos with Trip.com Group CEO Jane Sun about the trends she's seeing in the domestic and international markets.
For our business, it's doing very well. We have 4 segments. The first one is domestic travel. Not only we recover fully to 2019, we far exceeded 2019 by more than 50%. The second part is outbound travel, which is to bring Chinese travelers from China to the rest of the world. So we look at both demand side on our search as well as the supply side. The demand side already exceeded 2019 level. However, on the supply side, we still have 2 major hurdles. The first one is the visa application still takes too long, particularly to Europe and to the United States. The second hurdle is the flight capacity and shortage of the labor. I'm very hopeful in 2024 we'll do better in that segment.
I'm curious, though, whether Chinese consumers want to travel to Europe and the U.S. in the same kind of numbers we saw in 2019, or has something shifted as some of the international relations have frayed?
Not really. Chinese people are taught for 2,000 years to travel by Confucius. His teaching is it is better to travel 2,000 miles than to read 10,000 books. So parents always want to use travel as a means to educate their children. When you're traveling, you're not only learning theories, you are working with the people along the way. So Chinese people enjoy traveling.
Well, I'm just curious to see how this pairs with some of what we see in the economic data and some of what we're seeing out of even official rhetoric that just demand is not there. You look at loan demand falling off a cliff regardless of rates that have been falling pretty significantly. You talk about the potential for some sort of further stimulus. Where's the disconnect in all of the demand that you're seeing on your site and what we're hearing about from all of the other indicators?
Yeah, because China is very big, we need to look at different segments. Certain segments have pressure. For example, real estate might have some pressure. However, if people are not buying houses, their disposable income is increasing. So the segments that's doing very well, travel is doing very well, entertainment is doing very well. For example, concerts, music festivals, opera, these are doing very well. Wellness products are doing very well.
Trip.com Group CEO Jane Sun there with Bloomberg's Lisa Abramovich in Davos. Taking a look at some of the other stories that we're following this hour, SpaceX rocket was launched earlier, carrying the first all-European commercial crew to the International Space Station. The team is expected to dock at the orbiting research laboratory 250 miles above Earth on Friday. The blastoff is a landmark mission for Europe as its space industry struggles to get off the ground due to delays. Japan's space agency is attempting to shake off a series of recent setbacks in its latest attempt to land a probe on the moon this Saturday. A successful soft landing would put Japan in an exclusive company alongside the US, the former USSR, China and India. The agency, JAXA, lost contact with a lunar lander in 2022. Tokyo firm iSpace also failed last April. Shery.
Heidi, take a look at how we're setting up for the Asian session. We are seeing a little bit of upside for Kiwi stocks, reversing those losses that we saw in the previous session. We're seeing also the Kiwi dollar really steady at the moment. Same for the Aussie dollar. The ASX 200, of course, had lost ground for a 5th consecutive session and fallen to the lowest level in more than a month. And we're seeing some upside when it comes to futures trading right now, up 0.9%, and the Aussie also holding steady. We are waiting for Nikkei futures right now, up 1.6%. We have seen 3 sessions of losses for Japanese stocks already. The Japanese yen at the moment, little changed after falling to the weakest level since November. But the biggest data point, of course, Heidi, today will be Japan's CPI report. And we had seen Tokyo inflation already. That's, of course, a leading indicator for the national trend, weakening last month to the slowest pace in over a year. So that sort of gives you an indication that perhaps the Bank of Japan was right when he thought that those upward pressures on input costs were going to weaken. And of course, we're going to hear from them directly next week with the BOJ decision.
Yeah, big changes ahead for the BOJ this year and also for here at Bloomberg TV as well. Quick programming note, Daybreak Australia will be back next week with a new 7 a.m. Hong Kong time slot. You can tune in at 6 a.m. Tuesday to Saturday for Balance of Power, live from Washington, breaking down the biggest political news in what is, as we know, going to be a pivotal election year. Monday, 6 a.m. slot will feature the best of Bloomberg's long-form programming. Well, that is just about it for Daybreak Australia. We are going into Daybreak Asia next, as we do look like we're ending the week, the trading week in Asia, that is, on a high note. Asian equity futures are looking pretty happy at this point, looking to rally into the end of the week after those gains led by tech on Wall Street. The Nasdaq, of course, closing at a fresh record high. Watching for some of these Apple suppliers in Asia, with Apple climbing on that analyst upgrade, and also keeping an eye on gains expected when it comes to chip makers as well. That Taiwan semi outlook really lifting some optimism across chip makers that we could see a more robust recovery this year. The Open here in Sydney is next. This is Bloomberg.